Hi, this is Jim Welsh from macrotides.com. Thanks for tuning in. Well, equity markets across the globe have been selling off sharply in recent weeks. And as I'm recording this on March 18th, the S&P 500 has just dropped below its December 2018 low of 2347. Obviously, the coronavirus, its impact on the global economy, is the main driver of the weakness we're seeing in equity markets. But I think to have a better understanding of other factors that are causing this sell-off, we need to look at some other markets because they will maybe provide clues as to when the global liquidity squeeze, which is what I think has developed, is beginning to ebb. We know the Federal Reserve has lowered interest rates, injected an enormous amount of money into the financial system, and will expand its quantitative easing program beyond just Treasury bonds and mortgage-backed securities to include corporate bonds and potentially even stocks. None of that seems to be really working. And so the question is, why? Well, I think a couple things can be learned by looking at the dollar. So if you look at it, you can see that from mid-February until about a week and a half ago, the dollar sold off from about 99 down to 94.65, I believe. But in the last 2 weeks, it has gone vertical. And I believe what's happening is the dollar is normally a flight to safety trade, so money is flowing toward the dollar. But what is also happening is that there's an enormous demand globally above and beyond for dollar liquidity. There's $11.9 trillion in dollar-denominated bonds in emerging markets. So as this liquidity squeeze has gone global, it has driven money toward the dollar even more than just being a flight to safety. Normally, Treasury bonds are a beneficiary of any disruptions in the financial markets, obviously in terms of the stock market. And up until the last week and a half, that was certainly the case. In December, the 10-year Treasury yield was 1.94, and on March 9th got down to under 40 basis points. It is now up to 1.2%. So this, I think, is another indication of the liquidity squeeze that investors are facing. They're obviously getting killed in the stock market, and now they're being forced almost for liquidity reasons to sell Treasury bonds because they need liquidity. The same pattern is evident in the 30-year Treasury yield, got down to almost 84 basis points on March 9th, and has risen 100 basis points, even though the Federal Reserve has lowered the Fed funds rate by 100 basis points and injected all this liquidity. So to me, the run-up in Treasury yields is also a reflection of a liquidity squeeze that people are selling anything they can in order to get money. And lastly, you can see gold dropped from 1,700 to 1,450, has been hovering around 1,500. So here's another asset that supposedly would benefit from a flight to safety, but liquidity issues, I think, are causing investors to even sell gold. So in the days and weeks to come, I think a couple things will be worth noting. Seeing the dollar begin to decline, seeing Treasury bond yields start to fall again, will all be symptoms that or indications that liquidity is starting to calm the financial system. And once that happens, it'll be far easier for the equity markets to find some floor and level of stability. I'm going to do a separate video looking at the S&P, but this, I think, is one of the factors we need to keep in mind. Thanks for tuning in. May something good happen for you today. And more importantly, I hope everyone stays healthy. Thank you.